So, in this video, I'm going to be following on from my previous video talking about why screeners don't work. And I've touched on a bit on this in the other video, but I'm going to go into a bit more depth here. It's worth mentioning there are 4 things that I typically look out for that could improve the business's net income or sort of hide the business's net income, um, where the business is actually a lot more profitable than you may think as an investor. And then equally, I'll give you one negative sort of opposite where I'm sure there's a lot more each way, but this is a big one for me, where they may actually be losing significant amounts of capital, but sort of hide those losses. So the 4 main ones for me, I'll go in order, are: one is social media. I think this one particularly nowadays isn't appreciated by most investors who are, particularly sort of Wall Street, who are typically 60, 55-year-old sort of hedge fund managers. They're not really in touch with what's going on TikTok or Instagram. This is where your advantage can come in. If you see a particularly B2C, so direct to consumer sort of business models, where they're selling their apparel, their sort of clothes, their makeup, or whatever it is, and you see that they're going insanely viral, and this has not been reflected in their numbers, or you can see that the Google Trends is on an upwards direction, that might be something that isn't sort of baked in by your typical analyst, by your typical sort of hedge fund fund manager, and something where you know that the business is going to have a significant boost if it's a material sort of part of their business. It'd have to be like a core product or something where the demand is just off the charts. You're seeing reviews online, you're seeing comments on perhaps TikTok saying, "Oh, I can't get this anywhere. I've gone to this amount of stores and I can't get anything," or shipping is taking forever. It's taking 6 weeks because they're so sort of inundated with orders. That's when you know you've got a really good opportunity there that other people won't be picking up on, and that's a way that you can tell that the business's not only net income but its sales are going to probably spike during that period, and it could be something that's more of a sustained trend. Secondly is a bit more traditional, something where you might see sort of restructuring. I don't think is always appreciated in sort of or doesn't pull through in the stock screener, where if you know they've just spun off or sold one of their subsidiaries and they're planning to spin off another 2, they're in sort of discussion, and you know that they may be able to significantly reduce their debt burden by 50-70% or something of that sort. You can then calculate, well, how much is the business going to save in interest from not having to repay the interest on their debt anymore. So if you know, for example, they have let's say $100 million loan, or let's say a $200 million loan, and they're going to save 50% of that, and let's say they're traditionally paying 7% interest rate on that 200 million, they're paying back 100 million of that loan, then you know that their net income will increase by the 7% on 100 million, which they no longer have to pay in interest, which is £7 million, dollars, so forth. And that doesn't sound like a lot, but for a small cap, that can be a significant boost. If you're talking like a business that's only doing 50 million in net income per year, that's almost another 15% of their net income just uplifted from that sale there. It could be greater than that as well. I mean, particularly, I think this is one that's pretty big in sort of capital intensive industries, and particularly any sort of commodity type industry, or any other really sort of asset heavy, capital intensive industry, really. So they're 2 sort of ones that I'd look out for. There's 2 more. So these sort of tie hand in hand here, because you have essentially a more profitable product mix where potentially you're seeing that you might have a business with, let's say, 3 segments or 2 main core segments. And what you're noticing is that traditionally the slower growing, less profitable part of their business is sort of stagnating or growing at a slower pace, whereas you get the faster sort of higher net margin business. Again, this could work the other way, so keep that in mind. But if you get the higher sort of faster growing business, that might be able to drag sort of your net income margins up over time. So in fact, any sort of revenue growth would be accretive to net income margin, where you may start, in 2025 with 10% net income margins, and by sort of 2028 you might be sitting, or 2030 you might be sitting with 15% net income margins. So just on top of the revenue growth, you'll also be getting an extra 50% bump in sort of net income, and that's something to sort of take into consideration. What is their product mix? What's the impact going to be, particularly as those scales start to shift, where you get the higher net income producing business becoming a larger and larger segment of the business. Now, of course, this could work the other way, so it's something to watch out for. But another sort of similar method to that, which is sort of like my fourth thing that I look at, is the business two things. So is the business already profitable in one segment of their business, and the second segment of the business is a drag? Because in that instance, it may not be worth sort of calculating it on a net income basis, but maybe sort of calculating the profitable business separate, and then sort of calculating the sale value of the unprofitable business. If you were to sort of calculate like that, that's something that might not pull through in the screener, which may be to your advantage, because it may pull through as for example, mid sort of single digit net income margin business, whereas in actuality, the core of the business might actually be generating, mid-teen sort of net income year on year, and then you just have the unprofitable segment of the business sort of weighing it down. And that could always sort of, you can always sort of unlock value, particularly if you see management starting to talk about either becoming profitable or exiting that segment of the business. Could be for a sale to sort of generate cash, pay off debt, and so forth, which would again benefit the business, and that would sort of unlock value there. So that's sort of another thing there. But equally, you sort of have the segment where the business could actually be doing really well. It's quite profitable already, but they're just investing significant amounts of capital into their whether that be automation, whether that be into their systems, whether that be into their facilities. It's a capital intensive industry, and on top of that, what they might then be doing is depreciating very aggressively. So as they're scaling, as they're growing, because their depreciation is very aggressive. And what I mean by this is, for example, the machinery you may assess as an investor, oh, actually that's going to last them 10 years, but they're depreciating that over 4 years. So you're going to have a much larger sort of net income hit there, because the depreciation expense is going to be almost more than twice as high, which can significantly impact your net income margins. But in actuality, it's not. The business is a lot more profitable, and chances are the business is doing that to sort of be able to reinvest the capital, while a higher amount of capital, because they don't have to pay as much on taxes over the short sort of few years they're doing. Over the period they're expanding, and because they save money on not having to pay those taxes, they can then reinvest those incremental amounts, which will further build up sort of the business over time. That's something they could be doing, and that's something you may want to assess, particularly if you're a long-term investor who's willing to sort of sit in the company for 5, 10, 15 years. This could be sort of something that's underappreciated that you may benefit from. Amazon was a really sort of notable example of this. Now, whether they did it intentionally or not, they have always heavily sort of reinvested, particularly as they were growing, and that sort of concealed how profitable the business actually was. A lot of the time it showed us sort of break even or not that profitable, when in reality they were just going through a heavy sort of reinvestment period. Now, I did promise a negative one, and it's sort of off the back of reinvestment actually, because you have, particularly in sort of the commodity type business and software businesses, in fact, you have something which is known as sort of capitalizing expenses. And what this means is that a lot of the time, what some of these particularly commodity businesses and software to an extent, is they will essentially get costs which are associated to the business, and instead of treating them as a cost, they will shift that over into the asset segment of the balance sheet, which makes the business seem a lot more profitable than it actually is. This could be with, for example, the business might have spent $100 million developing the coal mine that they were going to then produce coal. Well, yes, technically it's increased the value of the coal mine, because previously this coal mine was unexplored, didn't have all the facilities in place, whereas now it has the facilities in place. If they were going to exit the business, they'd be able to sell the coal mine at a higher sort of amount essentially. But what this equally means is that the business could be burning through a lot of cash and it's not actually that profitable, but because they're able to sort of deploy a great amount of this cost over into sort of the asset sort of section of the balance sheet here, that can often mask the sort of the profitability of the business, or how much the business is actually losing, particularly from a cash flow perspective. Now, a lot of this is judgment as well. You'd have to make as an investor what you truly think deserves to go on there and what doesn't. And a lot of the time, it's worth looking into sort of the cash flow they have there in terms of, is the business losing significant amount of cash flow? Is the business already quite levered up on its balance sheet where during this sort of reinvestment period, can the business sort of handle any downturn that would potentially occur? Is that something that they could deal with their current sort of financial situation? Software companies also do this sort of with programming costs with developing a software. Ultimately, it could be argued it increases the value of the software. Again, it's a lot of judgment call, and that's why I'm not particularly a big fan of this. I would rather see the business go without it, or if it does, it'd be very conservative. I'd rather be too conservative than not in this scenario. I've seen it particularly with some sort of oil, gas sort of exploration companies that sort of do this, and I've seen a few commodity businesses do this as well. So not too keen on this overall, and something that I personally watch out for as well. It is generally pretty quick to spot if you can go onto the sort of 10K report and search basically for terms like capitalized expenses capitalized, and certain related terms. You can generally spot it pretty quickly. I mean, you've got AI nowadays. That's another quick way to check if you don't want to go into too much sort of detail. But then again, just going through the reports and so forth if you need to get a further sort of picture there. But that's my take. There's a few methods that you might want to keep in your back pocket. Let me know what you think. Thanks for listening.